Greetings and welcome back to our Climate Summit series. I'm David Fort, Senior Policy Advisor for Property and Casualty here at the Office of the Insurance Commissioner. In this episode, we're taking a look at a foundational component of our insurance market, entities that provide both financial stability and flexibility to the primary insurance companies that we interact with. We're very fortunate to have with us today Dennis Burke. Dennis, can you please introduce yourself and let us know who the Reinsurance Association of America is?
Thank you, David. I am Dennis Burke. I am a Vice President of State Relations with the Reinsurance Association of America. As you know, insurance is regulated at the states, so we need a states relations advocacy approach. I have been with the RAA for 17 years. And 15 years prior to that, I was with a reinsurance company. The RAA, the Reinsurance Association of America, is an advocacy organization. We represent the interests of reinsurers who write property and casualty risks in the United States. And we try to protect and give them opportunities to expand their market, as well as explain to legislators and regulators issues associated with the market and how it works.
Yeah, most consumers have no idea that there's this other insurance marketplace above their home and auto insurers. Can you explain the role of reinsurance?
Yes, and I'd just like to start with the point that I make to a lot of legislators. If you haven't heard of reinsurance, it means that you have a healthy insurance market. Simply, reinsurance is insurance for insurance companies. It can be written to cover one or more lines of property casualty insurance, but I think that consumers are most familiar with reinsurance written for property catastrophes, such as hurricanes, catastrophic wildfires, or earthquakes. It's a form of rented capital. So it's a standby contract that's entered into that is only triggered when there is a catastrophic event that is covered by the treaty, and it doesn't need to be repaid. So that's important. You pay your premium up front. You either have an event that is triggered or you don't. Someone once told me the most expensive reinsurance is the reinsurance you didn't buy when there has been an event. So what does reinsurance do? Reinsurance helps insurers manage their risks. It enables them to keep their promises to their policyholders in the event they have a significant number of losses. And it helps them meet their stakeholder, insurers or mutual policyholder members, return expectations. How reinsurance does this is it writes the risk and then spreads it and diversifies it in the global reinsurance pool. Typically, there's a number of reinsurers on any one treaty. And, in some places they ask about, why do you need to transfer it globally? Why would we transfer the premium out of our state? Well, the issue is when there is a catastrophic risk, and there's a catastrophe in Washington, Washington's economy will suffer. You want the economic stimulus and the money coming from outside to help the state rebuild and to recover. So one of the interesting things about reinsurance that a lot of people don't understand is that it's a voluntary transaction. Insurers choose to purchase reinsurance, and they do it because it works better for them than raising their own capital or issuing debt, because it's that standby facility that, you transfer a minor, typically a lower probability event, maybe a severe probability event for a reasonable premium. While I say it's optional, insurers tend to buy it because it works for them. It works for the business that they're writing. And if they didn't have reinsurance, they would need to have alternative capital or write less. So how do insurers go about purchasing reinsurance? Typically, they go through a broker, a reinsurance broker who represents the the insurers, and then they analyze their portfolio of business using, sophisticated tools called catastrophe models to estimate the amount of potential losses they may suffer. Then they decide how much risk they want to take, and they seek to transfer the rest and negotiate with insurers and reinsurers to try to develop an appropriate structure that protects them at a price they're willing to pay. And ultimately, when there is a loss, reinsurers pay their share of it pursuant to the contract. They pay fast. They help the insurers meet their obligations timely.
You mentioned that it's a global market. So I think many of us have seen the stories of wildfires in California, but wildfires in Portugal or Australia, and flooding in Germany, and hurricanes in Florida. And can you speak about how global property catastrophes over the past decade have impacted the current reinsurance market?
But that's a good question. I mean, so typically the reinsurance market is cyclical. That means that there are times when reinsurance is more expensive, which we call a hard reinsurance market in the business, and that's where reinsurers have the essentially pricing power compared to what is a soft market where competition is driving prices lower, and the insurers have the pricing power and can negotiate prices down. So reinsurance, like insurance, starts with an expectation of losses. So as reinsurers write their various books of business, and a lot of reinsurers write more than just property catastrophe risk, but they write it globally, and they estimate their losses of, what happens if there's a hurricane in Florida or the Gulf Coast, what happens if there's an earthquake in Japan, Indonesia. Largely the main sources of risk are the highly developed economies, which have large property concentrations and large values. They estimate their losses. Reinsurers purchase their own reinsurance. They'll transfer some of the risk themselves, and they estimate what risk they are willing to take on, and they create a budget. We anticipate, 25% of our surplus could be lost in a year or one event. So that's how the insurers and reinsurers work to evaluate their risk. And historically, the market is, I said, cyclical. It's sort of like an S wave. It goes up and down, and we are in the up segment of the cycle, and I'll tell you why. Because over the past decade, the first part of the past decade or so, it was a soft market cycle, and that was largely due to the fact that there had not been significant losses globally. Notwithstanding, in 2011, it was the first year with $100 billion loss of insured losses, and that was when Japan had the major event, which is called the Tohoku earthquake, or the Great Northeast Japan earthquake. As a result of that, the market, stabilized in 2011, and then it seemed to, for the next several years, continue to not have landfalling hurricanes in the United States, and that was beneficial and kept the market soft. Move forward a few years, losses began to increase. There were more and more events that hit reinsurers. So typically, insurers hold the more frequent events and can manage them within their own capital, and reinsurers assume the lower probability but potentially severe events. And both markets are structured and capitalized to address their own pieces. So it's the frequency of severity that became a problem in the reinsurance market, and as a result, reinsurers weren't making money they lost money or failed to meet their investors' expectations in 5 of the past 6 years. And that's before the Federal Reserve started raising interest rates, so they were largely competing against a very low risk-free rate. But they are taking on risk, and insurers want to insurer and reinsurer investors want to make sure that they have enough capital. In particular, in a number of states and across the Midwest, there have been severe convective storms that have damaged more properties than is typical. There have been derechos sweeping down from the west across the plains and into places such as Virginia or down towards Florida. And as a result, there have been thunderstorms that have created events that hit reinsurance, and you throw hail in there and some tornadoes, and it quickly becomes a potentially devastating storm. Since reinsurance pricing for wind events is largely based upon landfalling hurricanes in highly populated areas, there was a rethinking of how to approach the market, and that's how the market hardened. And so that happened in 22 and 23, and also in 2022 is when Hurricane Ian came aboard just south of Tampa, and that was a icing on the cake is probably not the right term, but it was the straw that broke the camel's back, and enough reinsurers lost money that their investors advised them that, and I know this from reading public releases as well as seeing videos such as this that are put on by conferences that are interested in reinsurance issues. And the result of that was a hardening market. But this is not the end of the world. 2023 actually wasn't that bad in terms of catastrophic losses. And hopefully reinsurers will make money and satisfy their investor needs this year. And typically, if there is an opportunity where reinsurers begin to make profits that investors believe are adequate, more competitors come in, and that in turn drives what becomes an eventual softening of the market. But for this coming year, per the broker reports, they're anticipating a stable renewal where insurers and reinsurers understand what each other wants, and the insurers will negotiate the covers that they want at the prices that are offered.
Yeah, well, that's really good to hear. Another term that I hear a lot, but I'm not quite sure how it works, is how do catastrophe bonds work, and how do they interact with the reinsurance market?
That's a really good question. Catastrophe bonds actually are a form of reinsurance, and what's interesting is it's a capital markets equivalent of reinsurance. And as we have advocated through the years, and as catastrophe bonds have matured, when we're engaged in negotiations with legislators, both state and federally, we encourage them to use the term reinsurance or capital market equivalents. One of those capital market equivalents is a catastrophe bond, which is really a special purpose reinsurance vehicle. That's what we call it. But for your audience, it's a disposable reinsurer. It is a reinsurer formed for a transaction. It's a securities transaction. Investors lend money to the entity that is formed in the catastrophe bond transaction, and that company uses that money to offer reinsurance to an insurance company, typically for a 3-year term, sometimes longer. That helps work through some of the cost issues associated with a catastrophe bond, because it is a disposable transaction and it's a securities transaction. That would be expensive in and of itself, but they write it for typically a 3-year period, and then to reinsure the funds that are left over, if there aren't losses, are paid to the investors, as well as the premiums are largely equating to a percentage rate of return that are paid during the term of the contract.
As regulators, reinsurance companies are often considered ahead of the curve, and for years have been raising the alarm of climate risk. Do you have a sense of what the future holds for our current reinsurance markets?
Yeah, it's hard to predict tremendously far out. Insurers and reinsurers, they do their own risk analyses, both for their enterprise risk management for themselves as well as for regulators, and that's typically looked out at a 5-year time frame. The pricing of reinsurance is typically on a 1-year time frame. Obviously, for a cat bond, as I said, sometimes that'll go out a little further. So that is largely those pricing mechanisms and near-term issues are largely based upon insurers and reinsurers' view of the weather that exists now. We've got a number of people who are now opining that many of our weather events are aberrational, and the aberrational events are caused by a changing climate, and that is a hard conclusion to scientifically prove, but it certainly seems that is happening. So reinsurers are looking at, and have been looking at, climate risk for a while. The worst of climate risk is not supposed to come for decades. It will, come in hiccups and aberrational events, and hopefully, we are currently adequately insured, consumers as well as insurers, to handle the risks that are coming in the next several years. But we do have an opportunity to evaluate the risks that we all are facing, where they're likely to occur. Is a drought going to happen in Washington State, or is it going to happen in California? Does Washington State's flora and flora change? Those are many of the issues that people are talking about, because climate change is now being layered into with the idea of biodiversity, because of just as crops die if bees don't pollinate them, there's a lot of interactions in the world, and so we need to be aware of all of the potential environmental impacts and look at them, and hopefully keep the ecology stable, which is important. But I think since it is ultimately in terms of the insurability of the events we're going to face, we need to evaluate what expected losses are going to be. And one of the advantages of looking further out is we can make changes now to prepare. So, the idea of building codes and land use. Where do we build? How do we build? Are rivers going to have higher precipitation events and hence higher flood levels? Should we build higher? Do we build on without basements and with piers? And what are the piers constructed of? How high should we build? All those issues are ones we can discuss now, and we can start for the new construction to build much stronger and much better, akin to the federal standard. Is how long do you expect the building to be in place, and what are the likely weather and related climate conditions, and build the building so it will survive and meet its expected life. And I think that's just a good standard just from a risk management perspective. And I think we should all look at those, and I recognize that most land use and building codes are enforced at the local level, but we need that. We all have a role to play in this, and we should all work on that. And we should work on trying to educate people that they should consider improvements as they do reconstruction in their homes. Strengthen them. And lifting your home is difficult, but perhaps after an event, you should rethink do something exactly different than what you had in place. And I think that's helpful. Reinsurers expect and want to be part of the current and future risk transfer scenarios, both now and as the climate changes. We can't do it by ourselves. Like I said, catastrophic risk is best insured by spreading the risk, so we can spread it globally, but we should also make sure that insurers are properly capitalized so they can keep risk. And then consumers as well as government entities need to do their parts to try to reduce risk however we can. Wildfire risk has the issues that communities should do. Prescribed burns, clearances and things of that nature. Dead wood should not be left standing in a wildfire prone area if possible. There's a lot of issues like that. Fortunately, I have not read that Washington State has the number of dead standing trees that California had, and that's beneficial for you, and that's the way you want to keep it.
Well, Dennis, thank you for your time today and speaking to our Climate Summit Series participants about the vital reinsurance market that is critical to the health of our insurance markets. Thanks again for your time.
Thank you. It's a pleasure.